Want to own a slice of a business that Warren Buffett has invested over $5 billion in? Looking for a 4% plus yield and a double-digit dividend growth rate? Like the idea of buying a high-quality dividend growth stock that looks to be on sale after a nearly 30% drop? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is one of the largest banks in the United States. Banks have been around since antiquity. Why have they been so enduring for thousands of years? Well, it's simple. Banks are in the business of money itself. What better business to be in to make money than, well, money? That's why this bank continues to grow its revenue, profit, and dividend like clockwork. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of US Bancorp, which appear to be trading at a significant discount today. US Bancorp, stock ticker USB, is a bank holding company that offers a diversified mix of financial services, including traditional retail banking, wealth management, commercial banking, and payment services. Founded in 1863, US Bancorp is now a $68 billion by market cap banking giant that employs 69,000 people. Operating as the fifth largest American bank by deposits, US Bancorp has over 3,000 branches spread out across 25 different states, primarily in the Midwest and West. The bank ranks first in deposit share in 4 states, while it has a top 5 position in 17 states. The company reports results across 5 business segments: consumer and business banking, 38% of fiscal year 2021 revenue, payment services, 26%, corporate and commercial banking, 17%, wealth management and investment services, 14%, and treasury and corporate support, 5%. What better business to be in to make money than in the business of money itself? The core banking business model is one of the best out there due to the quote-unquote float. Access to large sums of low-cost and low-risk capital deposits can be used to fund loans and other ventures that generate attractive returns. It's earning money off of OPM, or other people's money. Because of this, the banking business model is one of my favorite business models. But don't take just my word for it. Warren Buffett also loves the banking business model. He's invested heavily into a number of banks, including having approximately $5.5 billion invested in US Bancorp. Banking is one of the oldest business models in civilization, dating back to antiquity. Why is it so enduring? Well, it's simple. Society's ongoing prosperity has been, and continues to be, dependent on banking and the flow of capital. Without banking, our way of life essentially collapses. This leads me to strongly believe that banking will endure for many centuries to come, which bodes well for US Bancorp to keep growing its revenue, profit, and dividend well into the future. As things stand, the company has increased its dividend for 12 consecutive years. If not for the Great Recession, the bank would have a much more impressive dividend growth track record. Still, the 10-year dividend growth rate of 11.1% shows that US Bancorp has been making up for lost time. And you're able to pair that double-digit dividend growth rate With the stock's current yield of 4.1%, that yield blows away what the broader market offers. It's also 100 basis points higher than its own 5-year average. This is a super compelling mix of yield and growth. With a payout ratio of only 39.7%, this is a healthy dividend poised for many more sizable increases in the years ahead. Terrific dividend metrics right across the board here. Looking at business growth, US Bancorp advances revenue from $20.3 billion in fiscal year 2012 to $22.8 billion in fiscal year 2021. That's a compound annual growth rate of 1.3%. I would like to see a higher top-line growth rate, but the last decade has been unusually challenging for banks. Scars from the GFC have lingered, including historically low interest rates, additional regulation, and general caution around growth. And then we threw a global pandemic in there. All that said, the bottom line has fared better. The bank grew its earnings per share from $2.84 to $5.10 over this period, which is a compound annual growth rate of 6.7%. That's a bit more like it. I think this is actually a pretty good result when considering how difficult the last decade has been. Much of this excess bottom line growth was driven by share buybacks, with the outstanding share count down by 21% over the last decade. Looking forward, CFRA believes that US Bancorp will compound its earnings per share at an annual rate of 6% over the next 3 years. CFRA sees quote-unquote strength in net interest income, a continued rebound in payment services revenue, and weakness in mortgage banking revenue. So you have some strengths offsetting some weaknesses. CFRA adds further color and conviction, and I quote, "Over the next 12 months, we expect benefits from US Bancorp's digital transformation to result in positive operating leverage. Although we see higher growth rates in other regional banks, we are encouraged by US Bancorp's conservative risk profile as recessionary fears continue to mount." Unquote. I think that sums up US Bancorp perfectly. It's a conservatively run regional bank that benefits from diversification. It also illustrates what's so great about modern banks. Banks have taken a business model that's already incredibly enduring and lucrative, as I touched on earlier, and bolted on modern day fee-based opportunities such as credit cards, processing services, investment management, trust services, and various investment products. Indeed, the bank's payment services business segment comprises more than 1/4 of annual revenue. This is why US Bancorp was able to grow its earnings per share at a respectable rate during a very tough decade. However, the next decade could be a lot better for the company. We're getting further and further away from the GFC, the pandemic is mostly behind us, and rising rates benefit the large float. If we take CFRA's forecast as our base case for near-term earnings per share growth, that still sets up shareholders for at least high single-digit dividend growth over the foreseeable future. A low payout ratio allows for this. When you're looking at a 4% plus yield to start with, I think there's a lot to like about that picture. Moving over to the balance sheet, the bank has a great financial position. Total assets of $573 billion line up well against $518 billion in total liabilities. Their senior unsecured debt has the following credit ratings: A2 Moody's, A+ S&P, A+ Fitch. These ratings are well into investment grade territory. Profitability for the bank is among the best in the industry. Over the last 5 years, the firm has average annual net margin of 27.9%, an annual return on equity of 13.9%. Net interest margin came in at 2.5% last year. This is a terrific financial institution, which is probably why Buffett has given his seal of approval. And the bank does have durable competitive advantages that include economies of scale, sticky deposits, switching costs, established relationships, and an entrenched float. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. Banks are highly exposed to economic cycles. A recession could hurt the bank through reduced deposits and loan demand on the income statement, as well as higher credit losses on the balance sheet. If there are lasting economic scars from the pandemic, like there were from the GFC, this could create long-term growth headwinds for the company. Interest rates have been persistently low over the last decade, limiting growth, but rates are finally on the rise. US Bancorp has announced that it's acquiring MUFG Union Bank for approximately $8 billion through cash and stock, which adds near-term questions around execution and capital use. I see these risks as pretty standard for a bank, but the valuation could be quite special. After dropping nearly 30% from its 52-week high, the valuation now looks very appealing. The stock is trading hands for a price-earnings ratio of 10.6. That's almost half of where the broader market's PE ratio is at. It's also well off of the stock's own 5-year average PE ratio of 12.9. This stock typically has a pretty undemanding earnings multiple, but it appears to be especially undemanding right now. We can also see that the price-to-book ratio of 1.6 1.6 is lower than its own 5-year average of 1.7, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. That dividend growth rate is not as high nor as low as I can go. I think a down-the-middle approach works here. This is quite a bit lower than the demonstrated dividend growth rate over the last decade. On the other hand, it is fairly close to the bank's 10-year earnings per share compound annual growth rate, and it's not far off from CFRA's near-term projection for EPS growth. With the payout ratio at a modest level, I believe this is a reasonable, if conservative, judgment of the bank's dividend growth capability over the foreseeable future. The dividend discount model analysis gives me a fair value of $65.63. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates US Bancorp as a 4-star stock with a fair value estimate of $59. CFRA rates US Bancorp as a 3-star hold with a 12-month target price of $48. There's a range here, and I came out on the high end, but we all view the current pricing as favorable. Averaging the three numbers out gives us a final valuation of $57.54, which would indicate the stock is possibly 25% undervalued. Here's the bottom line, guys. US Bancorp is a large, high-quality financial institution that operates one of the world's most enduring and powerful business models. It's been able to buffer operational volatility through consistent fees, even while it should benefit from rising rates. With a market-beating yield, a double-digit dividend growth rate, a modest payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 25% undervalued, long-term dividend growth investors should consider investing in this company alongside Warren Buffett. And now for a special news announcement. Apple Inc., stock ticker AAPL, just had their annual unveiling of new products. The company announced a bevy of new offerings, including the iPhone 14 and the Apple Watch Ultra. Incremental improvements across the board should be more than enough to keep the Apple train rolling. And if you're not on it, you're at risk of being left behind. As I've said before many times, I think Apple is a must-own stock for serious long-term dividend growth investors. Do not sleep on Apple. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.